This is Audible.
Brilliance Audio presents the unabridged recording of Charlie Munger, The Complete Investor, by Trent Griffin, performed by Fred Stella.
Introduction. Charlie Munger is one of the world's most successful investors and most interesting people. He is best known as the outspoken partner of Warren Buffett at the fabulously successful company known as Berkshire Hathaway. Buffett acknowledged Munger's contributions when he pointed out, "1 + 1 with Charlie and me certainly adds up to more than 2. Munger's success as an investor in businesses outside of Berkshire is also impressive. What is most interesting about Munger is not his success as an investor, but the way he thinks and keeps his emotions under control. Munger's ability to cut to the heart of an issue with a few well-chosen words is legendary, as is his desire to think independently. A fundamentally important truth about investing is that people rarely make decisions independently. This means that people who can think independently, gain control of their emotions, and avoid psychological errors have an advantage as investors. Buffett once illustrated Munger's desire to do his own thinking with this story. In 1985, a major investment banking house undertook to sell Scott Fetzer, offering it widely but with no success. Upon reading of this strikeout, I wrote Ralph Skye, then and now Scott Fetzer's CEO, expressing an interest in buying the business. I'd never met Ralph, but within a week we had a deal. Unfortunately, Scott Fetzer's letter of engagement with the banking firm provided it a $2.5 million fee upon sale, even if it had nothing to do with finding the buyer. I guess the lead banker felt he should do something for his payment, so he graciously offered us a copy of the book on Scott Fetzer that his firm had prepared. With his customary tact, Charlie responded, "I'll give you $2.5 million not to read it." Warren Buffett, Chairman's Letter, 1999. Stories like this one, together with colorful reports on what Munger has said in a range of settings, are a big part of what motivated me to write this book. Munger is such an interesting person, in no small part because he is, in a word, unrestrained. He says exactly what is on his mind, with little consideration given to tact and social conventions. This candor is valuable because sometimes we need to hear that the emperor is not wearing clothes. Munger has said that, although he has accumulated an outstanding record as a stock picker and accumulated substantial wealth, people should not emulate his example in life in general. He believes his life has been too devoted to improving his own mind, and that peculiarities of his personality, including but not limited to irreverence, will make people unpopular if they blindly follow his example. Munger recognizes that he is a lightning rod that may attract criticism on some issues. Munger said once, "I may be remembered as a wise ass, whereas his investing partner, Warren Buffett, will be remembered as a teacher." People sometimes say to me that they do not understand the fuss about Charlie Munger. Unfortunately, they are missing a key point. No one can ever be Charlie Munger, just like no one can be Warren Buffett. The point is not to treat anyone like a hero, but rather to consider whether Munger, like his idol Benjamin Franklin, may have qualities, attributes, systems, or approaches to life that we might want to emulate, even in part. This same process explains why Munger has read hundreds of biographies. Learning from the successes and failures of others is the fastest way to get smarter and wiser without a lot of pain. Despite his irreverence, Munger is a teacher in his own inimitable way. He said once, "The best thing a human being can do is help another human being know more." Charlie Munger, Berkshire Annual Meeting, 2010. Much of what is interesting about Munger is explained by this simple sentence: I observe what works and what doesn't, and why. Life happens to Munger as it does to everyone. But unlike many people, he thinks deeply about why things happen and works hard to learn from the experience. Like Warren Buffett, Munger was born and raised in Omaha, Nebraska. He studied mathematics at the University of Michigan, but his path toward a college degree was interrupted by World War II. During the war, he served as a meteorologist in the U.S. military, receiving his training at the California Institute of Technology. After the war ended, he was able to secure a place at Harvard Law School without an undergraduate degree. He learned to like California during his time at Caltech, and after law school, he proceeded to form with a few partners what would become one of the nation's most prestigious law firms. Despite that success, he soon left the legal profession to invest on a full-time basis at the urging of Warren Buffett, whom he did not meet until after he was living in Pasadena, California. Between 1962 and 1975, Munger ran a partnership for a group of investors, which generated annual financial returns of nearly 20%, compared to a less than 5% return for the Dow Jones Industrial Average during the same period. Munger does not collect Ferraris or have a huge mansion. In many aspects of his life that do not involve ideas or investing, Munger is quite ordinary, despite being a billionaire. While Munger has delivered numerous speeches, written essays, and entertained legions of shareholders at Wesco Financial and Berkshire Hathaway annual meetings, his ideas have not yet been presented in a form that might be called a unified theory. This is probably because Munger's mind is capable of feats that are too hard for people of more conventional intelligence. For ordinary people, simultaneously juggling what he calls multiple models in their head is not an easy task without an understandable framework for the ideas. The intent of this book is to teach you how to think more like Charlie Munger. How did I find my way to the ideas of Munger? The genesis of this book can be traced to the period immediately before the collapse of the Internet bubble. Many assumptions about investing were being questioned during this time. The wealth created during the Internet bubble was unreal to anyone paying attention. Mark Andreessen expressed it well when he said on Twitter that during this bubble, the overwhelming feeling people had was panic, that they were missing out. What was going on seemed to be mass insanity, but most people thought to themselves, what if it's real? What if value doubled or tripled again? It was natural for anyone who, like me, was seeking answers about what was going on in the markets during this crazy period to read the reviews of successful and thoughtful investors. To cope with what was going on in the markets, in the summer of 1999, I chartered a boat, hired a skipper, and told him to take my family to the San Juan Islands in Washington State. I took everything that had ever been written by and about Buffett with me on that trip. As I read Buffett's investing methods sitting on the deck of that boat, I found that it was actually Munger's ideas that resonated most with me. The specific question I most wanted answered at that time was how much of my stock in highly appreciated Internet and telecommunications companies I should sell. My family had a blast on the boat in the islands while I read and paced back and forth on the deck deep in thought. I did little else for a week but read and think. I was not a lot of fun on that trip. However, as the trip drew to a close, I had reached my conclusion. I would sell exactly half my Internet and telecom stocks. I decided that this would minimize regret no matter what happened. It was not an optimal decision given the crash that followed, but I was happy with my decision then and remain so today. That trip was the start of my deep dive into value investing. The value investing system, developed by Ben Graham and used by Munger, is the single best way for an ordinary investor to outperform a market index. While Graham value investing is a system, it is not possible for an investor following this approach to find success simply by following a set of rigid rules. The implementation of the Graham value investing system, the Berkshire system, or the systems of other value investors is an art, not a science. Value investing is not a connect-the-dots exercise. While fully understanding the Graham value investing system does not involve rocket science, most people will find that they either do not have the emotional and psychological control required or do not want to do the work necessary to outperform a market index. This is why Warren Buffett likes to say that investing is simple but not easy. Munger's version of what Buffett said is, take a simple idea and take it seriously. Much of this book is about how I have learned to better identify sources of emotional and psychological mistakes and what I learned from Munger about avoiding them. Wall Street Journal columnist Jason Zweig described one of the essential challenges in investing in an email to me. If it was easy to be like him and think like him, then there wouldn't be just one Charlie Munger. Turning oneself into a learning machine with multiple mental models is very hard work, and the few people who succeed at doing it may still fail to benefit from it if they don't have the right temperament. This is why both Buffett and Munger keep going back to Graham. Being a true contrarian takes supreme courage and implacable calm. Buffett talks constantly about the emotional framework Graham provides. Charlie often says that most investors, no matter how smart, won't succeed because they have the wrong temperament. I like to use a word from an ancient Greek philosophy to describe this: ataraxia, or perfect imperturbability. You see it when Socrates goes on trial, when Nathan Hale is hanged, when Buffett invests in Goldman, and when Charlie buys Wells Fargo the day before the bottom tick in March 2009. Jason Zweig. Email to author, October 2014. To help myself better understand Munger's ideas and methods that relate specifically to investing, I created a framework composed of 3 elements: principles, the right stuff, and variables. This 3-part framework is only one type of model that can be used to understand Munger's ideas and methods about investing. Other approaches to understanding Munger can be just as useful. My other intent in creating this framework was to create a checklist that can be used in investing. Munger is a strong proponent of a checklist approach to life's challenges. I'm a great believer in solving hard problems by using a checklist. You need to get all the likely and unlikely answers before you. Otherwise, it's easy to miss something important. Charlie Munger, Wesco Annual Meeting, 2007. Part of the benefit of creating a checklist is the process of writing down your ideas. I have always loved the point Buffett made about the importance of making the effort to actually put your ideas in writing. In Buffett's view, if you cannot write it down, you have not thought it through. To best fulfill the promise of a book entitled Charlie Munger, The Complete Investor, it is essential to start out with a discussion of Graham value investing fundamentals, because that will help convey an outline of where this book is going. The 4 fundamental principles of value investing as created by Ben Graham are as follows. 1. Treat a share of stock as a proportional ownership of the business. 2. Buy at a significant discount to intrinsic value to create a margin of safety. 3. Make a bipolar Mr. Market your servant rather than your master. 4. Be rational, objective, and dispassionate. Munger has said these 4 bedrock Graham principles will never be obsolete. An investor who does not follow these principles is not a Graham value investor. The Graham value investing system really is that simple. Munger also believes the development and recognition of certain personal attributes are essential for a Graham value investor. These attributes represent the right stuff part of my framework. Munger believes that investors who can develop these attributes can train themselves to avoid common psychological and emotional mistakes and become successful investors. No one is ever going to be anything approaching perfect, but we can all get better over time. If we do not work constantly to improve these attributes, Munger believes, we can relapse into old mistakes and folly. The final section of the book will discuss choices that a Graham value investor can make in establishing his or her own investing style and methodology. In other words, variations on the Graham value investing system can be created on top of the 4 fundamental value investing principles. No 2 Graham value investors are exactly alike in how their investing system is implemented. As just one example, Buffett has pointed out that while he and Munger are Siamese twins practically, they do have some differences in their approaches to investing. The learning and teaching opportunities related to investing are essentially unlimited. Munger likes to say that a successful investor never stops being a learning machine. This need to learn and relearn means that an investor must read and think constantly. Munger has said he does not know a single successful investor who does not read voraciously. His own children describe him as a book with legs sticking out. Reading and learning will require some real work. There is a Zen saying that can be made applicable to this point. In matters related to value investing, many people prefer chewing the menu to actually eating the food. I have learned not only to do the work, but to love the work because it is intellectually satisfying. You can learn to at least enjoy the process, and maybe even love it too. Before concluding this introduction, I should make a few points about the book itself. Its format is simple. Quotations from Munger have been set out in a logical order, typically followed by an explanation that I have written. The best way to teach people about how Munger thinks is to examine the dominant professional activity of his life in some depth. This book's focus is on how Munger thinks as an investor. Munger has called being a successful investor a trained response. He believes that if you can learn to overcome behavior that drives poor decisions, you can gain an edge over other investors. Much of the context of the book will be about how Munger invests, but the discussion is just as applicable to making decisions in other aspects of life. By understanding the framework that supports Munger's ideas and methods, each of his individual public statements has even more meaning. For example, by learning about what he calls worldly wisdom and the psychology of human misjudgment, you can make better decisions. Learning about Munger's ideas and methods will forever change the way you think about investing and about life. You will make better decisions, be happier, and live a more fulfilling life. 1. The basics of the Graham value investing system. Let's get started with the most fundamental questions. What is the Graham value investing system, and who can benefit from it? Ben Graham was trying to invent a system anybody could use. Charlie Munger, University of Southern California Business School, 1994. The critical point about Graham's system is that it is simple. Too many people take a situation and create complexity where none is needed. Take, for example, the old joke about unnecessary complexity at the National Aeronautics and Space Administration. The storyteller starts by saying that early in the space program, NASA discovered that ballpoint pens would not work in zero gravity. NASA scientists spent a decade and huge amounts of money developing a pen that wrote not only in zero gravity, but on almost any surface at extremely low temperatures and in any position of the astronaut. The punchline is, the Russians instead used a pencil. Graham value investing has the inherent simplicity of the pencil. Munger believes that Ben Graham developed his value investing system to be relatively simple to understand and implement, and thus valuable to an ordinary person. Graham value investing is not the only way to actively invest or speculate. For example, venture capital and private equity are very different approaches to investing from value investing. But Munger believes that these alternative active investing systems are not as accessible to the ordinary investor as Graham value investing is. So-called index-based or passive approaches to investing will be discussed shortly. Warren Buffett says that investing is simple but not easy. When Graham value investors make mistakes, it is usually because they have done things that are hard for humans to avoid, like forgetting the inherent simplicity of the Graham value investing system, deviating from the fundamentals of the system, or making psychological or emotional mistakes related to implementation of the system. Because investing is a probabilistic activity, decisions made in ways that are fundamentally sound may sometimes produce bad results. Sometimes a person will produce an unfavorable result even when his or her process is well constructed and executed. However, in the long run, it is always wise to focus on following the right process over any specific intermediate outcome. Munger believes that when creating a successful investing process, complexity is not the investor's friend. We have a passion for keeping things simple. Charlie Munger, Wesco Annual Meeting, 2002. Peter Bevelin's book, Seeking Wisdom, From Darwin to Munger, has a section on the importance of simplicity. Bevelin advised, turn complicated problems into simple ones. Break down a problem into its components, but look at the problem holistically. Keeping things as simple as possible, but no more so, is a constant theme in Munger's public statements. In a joint letter to shareholders, Munger and Buffett once wrote, simplicity has a way of improving performance through enabling us to better understand what we are doing. By focusing on finding decisions and bets that are easy, avoiding what is hard, and stripping away anything that is extraneous, Munger believes that an investor can make better decisions. By tuning out folly and swatting away unimportant things so your mind isn't cluttered with them, you're better able to pick up a few sensible things to do, said Munger. Focus enables both simplicity and clarity of thought, which in Munger's view leads to a more positive investing result. If something is too hard, we move on to something else. What could be simpler than that? Charlie Munger, Berkshire Annual Meeting, 2006. We have 3 baskets, in, out, and too tough. We have to have a special insight, or we'll put it in the too tough basket. Charlie Munger, Wesco Annual Meeting, 2002. The Graham Value Investing System is designed to remove from the process any decisions that may lead an investor to make mistakes. The yes basket is tiny compared to the other 2 baskets, because an investing decision that results in a yes will happen rarely. Not all companies can be accurately valued using a Graham value investing process. It is perfectly natural for a person who follows the Graham system to acknowledge that fact and move on to other easy decisions. It is often disorienting to some people that a Graham value investor would admit to not knowing how to accurately value a company. Munger made this point with an analogy. Confucius said that real knowledge is knowing the extent of one's ignorance. Aristotle and Socrates said the same thing. Is it a skill that can be taught or learned? It probably can, if you have enough of a stake riding on the outcome. Some people are extraordinarily good at knowing the limits of their knowledge, because they have to be. Think of somebody who's been a professional tightrope walker for 20 years and has survived. He couldn't survive as a tightrope walker for 20 years unless he knows exactly what he knows and what he doesn't know. He's worked so hard at it because he knows if he gets it wrong he won't survive. The survivors know. Charlie Munger, Jason Zweig Interview, 2014. Graham value investing is not about showboating or flouting one's intelligence. Instead, it is about doing things that are not likely to result in a mistake. The successful Graham value investor also works diligently to reduce the downside risk of any investment. For this reason, the Graham value investing system tends to shine most brightly during a flat or falling stock market. The Graham value investing system is intentionally designed to underperform an index in a bull market. This is confusing to many people. The underperformance of the Graham value investing system during a bull market is an essential part of this style of investing. By giving up some of the upside in a bull market, the Graham value investor is able to outperform when the market is flat or down. Consider what Seth Klarman wrote in Margin of Safety. Most investors are primarily oriented toward return, how much they can make, and pay little attention to risk, how much they can lose. He added, the payoff from a risk-averse, long-term orientation is just that, long-term. Here is a story to further illustrate this point. An investor was walking in a park one day when she saw a frog sitting on a log at the edge of a pond. The frog looked right at her and said, "Excuse me, would you happen to be an investor?" The investor replied, "Yes, I am. Why do you ask?" "Well," replied the frog, "I am a stock speculator. My best client did not like my investing results, so he put a spell on me, and now I am a frog. The spell can be broken if an investor will kiss me." The investor immediately reached over and picked up the frog, put him in her purse, and then started to walk home. The frog was concerned that he was not receiving a kiss and asked, "What are you doing? When do I get my kiss?" The investor replied, "I'm not kissing you ever. You're worth a lot more to me as a talking frog than as a stock speculator." If you cannot accept investing underperformance in the short term in order to achieve long-term investment outperformance, then you are not a candidate for Graham value investing. This is not a tragedy, since the Graham value investing system is not the only way to invest successfully. It is important to note that the goal of the Graham value investor is superior absolute performance, not just relative performance. An investor cannot spend the output of relative performance, only actual performance. Failing conventionally is not the goal of the Graham value investor. Munger's approach is to invert the methods of most people. It is remarkable how much long-term advantage people like us have gotten by trying to be consistently not stupid, instead of trying to be very intelligent. There must be some wisdom in the folk saying, "It's the strong swimmers who drown." Charlie Munger, Wesco Annual Report, 1989. What's the flip side? What can go wrong that I haven't seen? Charlie Munger, Forbes, 1969. Munger's inclination to invert the usual approach to solving a problem is clearly evident when it comes to investing. In his view, investors will do better financially simply by being less stupid. One core idea Munger has borrowed from algebra is that many problems are best addressed backward. For example, by avoiding stupidity, a person can often discover what he or she wants through subtraction. By eliminating the stupid paths that one can take in life, a person can find the best way forward, even given inevitable risk, uncertainty, and ignorance. Not only does one often know a lot more about what is wrong than what is right, but disproving something may also require only one observation. In short, Munger's view is that being smart is often best achieved by not being stupid. Once in an interview with Jason Zweig, Munger said it simply, "Knowing what you don't know is more useful than being brilliant." Munger strives to find investments for which a significantly positive outcome is obvious. Because this type of investment is identified only rarely, Munger suggests that one be very patient, but also very ready to aggressively invest when the time is right. To use a baseball analogy, Munger knows there are no called strikes in investing. So there is no need to swing at every pitch. When you find an obvious bet with a big upside, Munger's advice is simple: bet big. All the equity investors in total will surely bear a performance disadvantage per annum equal to the total croupier's costs they have jointly elected to bear. This is an inescapable fact of life. And it is also inescapable that exactly half of the investors will get a result below the median result after the croupier's take, which median result may well be somewhere between unexciting and lousy. Charlie Munger, Philanthropy, April 1999. The point Munger makes immediately above about investing as a less than zero-sum game after fees and expenses is mathematically irrefutable. John Bogle, the founder of the nonprofit mutual fund provider Vanguard, is perhaps the most successful person to ever evangelize this simple idea. Bogle wrote, "In many areas of the market, there will be a loser for every winner, so on average, investors will get the return of that market less fees." Columbia Business School professor, investor, and author Bruce Greenwald had his own take on this point, which I find compelling. Only in woebegone can people outinvest the market. The average performance of all investors has to be the average performance of all assets. It's a zero-sum game if you judge it relative to the market. There are two sides to every trade. The best way to think about it is that every time you buy a stock, someone is selling. So you always have to ask the question, why am I on the right side of this trade? Bruce Greenwald, Betterment Interview, 2013. Graham value investing would not work if markets were perfectly efficient. For this reason, the market's folly is the fundamental source of the Graham value investor's opportunity. Munger's take on why investing is hard is simple. The idea that everyone can have wonderful results from stocks is inherently crazy. Nobody expects everyone to succeed at poker. Charlie Munger, Daily Journal Meeting, 2013. If investing weren't a little difficult, everybody would be rich. Charlie Munger, Damn Right, 2000. For a security to be mispriced, someone else must be a damn fool. It may be bad for the world, but not bad for Berkshire. Charlie Munger, Wesco Annual Meeting, 2008. Because the degree to which investors may collectively act like damn fools varies over time, opportunities to generate investment gains will inevitably arrive in a lumpy fashion. Successful Graham value investors spend most of their time reading and thinking, waiting for significant folly to inevitably raise its head. Although Graham value investors are bullish about the market in the long term, they do not make investing decisions based on short-term predictions about stocks or markets. When confronted with this idea, people will often ask, "Do you mean Graham value investors wait for mispriced assets to appear rather than predict the future in the short term?" The answer is an emphatic yes. The Graham value investor's job is to recognize mispriced assets when he or she sees them. This approach is hard for many people to accept. At the core of the system is the idea that the investor must let go of his or her desire to make short-term predictions about the future. Some people just can't do that. Klarman wrote, "The value discipline seems simple enough, but is apparently a difficult one for most investors to grasp or adhere to. As Buffett has often observed, value investing is not a concept that can be learned and applied gradually over time. It is either absorbed or adopted at once, or it is never truly learned." Seth Klarman, Margin of Safety, 1991. As will be explained, the time of greatest activity for a Graham value investor is when the people who make up the market are fearful, as evidenced by mispriced assets available for purchase. It is ironically because of downturns in the markets that the Graham value investor finds his or her greatest source of profits. Munger pointed this out. Most people who try investing don't do well at it. But the trouble is that if even 90% are no good, everyone looks around and says, "I'm the 10%. Charlie Munger, Wesco Annual Meeting, 2004. This aspect of human nature can be a troubling fact for a financial planner. Is it dangerous to tell a client that beating the market is possible even if you know that there is little chance that this person will actually do so? It may not be dangerous in and of itself, but it certainly creates substantial risk. The following is common, yet perfectly good advice about investing and is true in most cases. It's not possible for investors to consistently outperform the market. Therefore, you're best served investing in a diversified portfolio of low-cost index funds or exchange-traded funds. Although this advice is mostly true, it is provably false in the case of investors like Charlie Munger, Warren Buffett, Seth Klarman, Howard Marks, Bill Ruan, and other Graham value investors. Munger once said, "The top 3 or 4% of the investment management world will do fine." The fact that Munger has outperformed the market does not necessarily mean that you can. However, it does mean that it is possible for some people to accomplish. Munger said the following about the Graham value investing system. "It's a very simple set of ideas, and the reason that our ideas have not spread faster is they're too simple. The professional classes can't justify their existence if that's all they have to say." Charlie Munger, BBC interview, 2009. Successfully learning and especially implementing the Graham value investing system is what Munger has called a trained response. You must learn to overcome certain behavior that drives poor decisions. If you can do that successfully, Munger believes you can create an investing edge over other investors. Part of that trained response is to avoid distracting noise made by people who do not understand investing, or who have a financial interest in keeping you from understanding investing. The task is made vastly harder by people who generate their income by making the investing process overly complex and harvesting their living from the psychological and emotional dysfunctions of investors. Munger told a story about the incentives of investment managers that is instructive. "I think the reason why we got into such idiocy in investment management is best illustrated by a story that I tell about the guy who sold fishing tackle. I asked him, 'My God, they're purple and green. Do fish really take these lures?' And he said, 'Mister, I don't sell to fish.'" Charlie Munger, USC Business School, 1994. It can be hard for some people to make a living selling you something that is simple, but it is the best approach for the investor. Fortunately, the function of financial planning is being separated from the process of managing money. A financial planner provides the greatest value for clients simply by helping investors keep their emotional and psychological dysfunctions under control. If this behavior modification is effective, the financial planner will employ a range of techniques to help you not be your own worst enemy. In some cases, intense competition has started to reduce fees and increase transparency in financial planning and money management businesses. This competition has caused many financial planners to focus on more valuable services for customers, such as retirement and estate planning. Some fees for money managers have come down as well. Munger's advice is simple for people who decide that they should not try to outperform markets. Our standard prescription for the know-nothing investor with a long-term horizon is a no-load index fund. Charlie Munger, Kiplinger interview, 2005. Who is a know-nothing investor? The answer is simple for Munger. A know-nothing investor is someone who does not understand fundamentals of investing. Here is a simple suggestion from Seth Klarman for know-nothing investors. If you can't beat the market, be the market. Buffett agreed. By periodically investing in an index fund, for example, the know-nothing investor can actually outperform most investment professionals. Paradoxically, when dumb money acknowledges its limitations, it ceases to be dumb. What Buffett was talking about is the question of whether a person should be an active or passive investor, concepts he learned from Benjamin Graham. Passive investors are not completely passive because they still have choices to make. For example, passive investors must make asset allocation decisions, i.e., which types of investments to make, and determine what types of indexes to use within those asset classes. When making these choices, investors can still make emotional and psychological errors. Even though passive investors must make some decisions, they are called passive because they do not make as many decisions as active investors. A better approach is perhaps to call these passive investors index investors. If a person is investing in a diversified portfolio of index funds and exchange-traded funds, ETFs, then he is an index investor. If a person is picking individual stocks and other securities, then she is an active investor. Many people engage in a mix of active and index investing. For example, some index funds are tweaked and include some choices about factors that can improve their performance. This factor style of index investing is discussed in the last section of this book, Value Investing versus Factor Investing. Being an active investor and somehow outperforming the market after fees and expenses may sound good to you. However, being a successful active investor requires massive amounts of time and work, plus the right emotional temperament. If you do not enjoy it, why do it? William Bernstein wrote, "Successful investors must possess an interest in the process. It's no different from carpentry, gardening, or parenting. If money management is not enjoyable, then a lousy job inevitably results, and, unfortunately, most people enjoy finance about as much as they do root canal work." William Bernstein, The Investor's Manifesto, 2012. In any event, investors must still make several key investing decisions, and understanding the ideas and methods of Munger will help them do so more successfully. Columbia Business School professor Bruce Greenwald summed up the challenge as follows. Emotions are absolutely your enemy. You want to be a certain kind of mutant who is just completely different in their orientation to what's an attractive investment for the rest of the market. Can you be the mutant that Professor Greenwald described? As you read this book, think about whether you have the right stuff required to be a successful Graham value investor like Munger. Can you understand and implement the principles to make the required choices about value investing variables? It may well be that you find the whole investment process too boring to do it well enough to beat the market. You may conclude that you're too easily distracted, are likely to panic at the wrong time, or will too often follow the crowd into poorly performing investments. If you cannot be an effective Graham value investor, or don't want to put in the effort required to do so, invest in a diversified portfolio of low-cost index funds and ETFs. Some investors knowingly do a small amount of active investing for fun, much as they might gamble in Las Vegas. This can be logical as long as people remember that gambling is, well, gambling. Knowing the difference between gambling and investing is important. Investing is an action that defers consumption in the present in the hope that you will be able to consume more in the future. An investor has an expectation of a positive real rate of return, even though it is possible that this will not happen, especially in the short term. In other words, an investment is a net present value positive activity. The likelihood of the net present value of the potential benefits minus the likelihood net present value of the potential losses is positive. Gambling is a form of present moment consumption, and the net present long-term value of the activity is negative. Many people who think they are investing are actually gambling. Some people try to outperform the market by saying essentially, I can be smart about picking other people who will outperform the market via active investing. Munger believes that if something related to active investing is worth doing, then it is worth doing yourself. Munger has said on this point, I think you'll at least make fewer mistakes than people who think they can do anything, no matter how complex, by just hiring somebody with a credible label. You don't have to hire out your thinking if you keep it simple. Charlie Munger, Berkshire Annual Meeting, 1994. What Munger meant is that outsourcing active investing to others, such as investment managers and brokers, is harder than doing it yourself. One way of doing it yourself is by buying a diversified portfolio or index funds/ETFs. Unfortunately, this approach is not enough to achieve financial success because investors must still make important investment choices. They will too often chase performance by buying into funds/ETFs when the market is high and selling when the market is low. If index investors did not need to make some choices, there would not be a behavior gap of approximately 2% between investors and the investing funds they buy. In other words, even if you choose to be an index investor and buy a low-cost portfolio of funds/ETFs, you still need to develop the trained response that will enable you to overcome the behavioral biases that can lead to making mistakes. What Munger teaches about investing is applicable in its own way to index investors. The ideas and methods described in this book are still very important for an index investor. 2. The principles of the Graham Value Investing System. The number one idea is to view a stock as an ownership of the business. Charlie Munger, Harvard Law Bulletin, 2001. Understanding how to be a good investor makes you a better business manager and vice versa. Charlie Munger, Kiplinger, 2005. First principle: treat a share of stock as a proportional ownership of a business. This first principle of the Graham Value Investing System is the foundation on which any valuation must begin. Put simply, if you do not understand the actual business of the company, you cannot understand the value of assets related to that business, like a share of stock or a bond. Graham Value investors approach any valuation as if they were actually buying a business in a private transaction. In buying a business, Munger believes the place to start is at the bottom, with business fundamentals, and work up. What does the company sell, and who are its customers and competitors? What are the key numbers that represent the value the business generates? The list of important questions that an investor must answer is extensive. For a true Graham Value investor, there is no substitute for a bottom-up valuation process. In undertaking this process, Graham Value investors are focused on the present value of the cash that will flow from the business during its lifetime, and whether the business generates high, sustained, and consistent returns on capital. Many supplemental variations on this process exist, but the fundamental core of the valuation process is the same for all Graham Value investors. Effective Graham Value investors are like great detectives. They are constantly looking for bottom-up clues about what has happened in the past, and more importantly, what is happening now. Graham Value investors like Munger stay away from making predictions about how cash flows will change in the future based on projections and forecasts. What Munger looks for is a business that has a significant track record of generating high, sustained, and consistent financial returns. If valuing the business requires understanding how cash flows will change in the future based on factors like rapid technological change, Munger puts that business in the too hard pile and moves on to value other companies. Munger makes it quite clear that he does not have a way to value all companies, which is fine with him because he feels no need to do so. There are more than enough businesses that Munger can value using his valuation method to make him happy as an investor. The key to understanding this first principle is understanding that Munger believes that a share of stock cannot be divorced from the fundamentals of the specific business. Munger's response to people who doubt his approach can be phrased as a question. If a share of stock is not a partial stake in a business, what exactly is it? Jason Zweig of the Wall Street Journal, who is a hero to Graham value investors, wrote that a stock is not just a ticker symbol or an electronic blip. It's an ownership interest in an actual business with an underlying value that does not depend on its share price. For a Graham value investor, a share of IBM stock is just a small share of IBM's overall business. Munger believes that treating shares of a company as if they should be valued like baseball cards is a loser's game, because it requires that you predict the behavior of often irrational and emotional herds of human beings. A Graham value investor puts short-term predictions about mass psychology in the too hard pile and focuses on what he or she can do successfully with far greater ease. Graham value investors do not spend time with top-down factors like monetary policy, consumer confidence, durable goods orders, and market sentiment in doing a business valuation or investing. Be motivated when you're buying and selling securities by reference to intrinsic value instead of price momentum. Charlie Munger, Damn Right, 2000. As Ben Graham once pointed out, it's an almost unbelievable fact that Wall Street never asks, how much is the business selling for? That a famous Graham value investor like Munger or Buffett may make a statement about current economic conditions or market indicators does not mean that they purchase stocks based on that view, or that they think they can make successful predictions about what the macroeconomy might do in the short term. Famous Graham value investors may also make positive statements in the press and at conferences about the future state of the economy in the long term. However, that does not mean they make investments based on those forecasts. There is a huge difference between what is interesting to learn about and what is useful in making an investment decision. For example, both Munger and Buffett are famously bullish on the U.S. economy in the long term, but that does not mean they make short-term predictions about the economy or incorporate them into investment decision-making. Munger is adamant about many points, including this core belief. You must value the business in order to value the stock. Graham value investors price assets based on their value to a private investor now, based on data from the present and past, rather than making predictions about markets in the future. If you focus on the value of the business, you have no need to predict short-term changes in the economy, because that takes care of itself. When stocks are a bargain, people are fearful. When stocks are expensive, people are greedy. Crowd folly, the tendency of humans under some circumstances to resemble lemmings, explains much foolish thinking of brilliant men and much foolish behavior. Charlie Munger, Philanthropy Roundtable, 2000. If you do not follow the business to value the stock approach, in the view of Graham value investors, you are a speculator and not an investor. If you are an investor, you are trying to understand the value of the asset. By contrast, a speculator is trying to guess the price of the asset by predicting the behavior of others in the future. In other words, a speculator's objective is to make predictions about the psychology of large masses of people, which, if you are both smart and experienced, is a sobering thought. How good are you at predicting what people will do once assembled into a mob? The big danger related to this tendency is that you just end up following the crowd and doing what Munger talked about here. Mimicking the herd invites regression to the mean, merely average performance. Charlie Munger, Poor Charlie's Almanac, 2005. When speculators spend their time trying to guess what other speculators are trying to guess, the process quickly becomes both circular and absurd. Graham value investors do not treat a share of stock or a bond as a piece of paper to be traded back and forth. They also do not spend any time looking at technical charts of stock price movements, searching for things like double bottoms or Hindenburg omens. The financial performance of speculators is, in a word, dismal, especially after fees, costs, and taxes. Even when speculators are right, it is almost inevitable that they are correct only once in a while. Too often investors confuse luck with skill. Munger is a firm believer in the Ben Graham view that an investment operation is one which, upon thorough analysis, promises safety of principal and an adequate return. Operations not meeting these requirements are speculative. Buffett has his own version. If you're an investor, you're looking on what the asset is going to do. If you're a speculator, you're commonly focusing on what the price of the object is going to do. And that's not our game. Warren Buffett, Outstanding Investor Digest, 1997. If you always bet with the crowd, you cannot beat the market, especially after fees, costs, and taxes. To outperform the market, sometimes you must be a contrarian. And you must be right on enough of those occasions when you're a contrarian. For example, people who day trade stocks using charts of past prices and other voodoo-like practices are speculators. You will hear them talk about how the market behaves rather than what the value of a given stock may be. A guess about market behavior based on a chart is just that, a guess. Speculators are focused on price, whether it may be an old baseball card or a share of stock. Graham value investors have a very different view than speculators. Seth Klarman wrote that technical analysis is based on the presumption that past share price meanderings, rather than underlying business value, hold the key to future stock prices. Buffett used a story to illustrate the dangers of herd behavior in one of his chairman's letters. Ben Graham told a story 40 years ago that illustrates why investment professionals behave as they do. An oil prospector moving to his heavenly reward was met by St. Peter with bad news. "You're qualified for residence," said St. Peter, "but as you can see, the compound reserved for oilmen is packed. There's no way to squeeze you in." After thinking a moment, the prospector asked if he might say just 4 words to the present occupants. That seemed harmless to St. Peter, so the prospector cupped his hands and yelled, "Oil discovered in hell!" Immediately, the gate to the compound opened and all of the oilmen marched out to head for the nether regions. Impressed, St. Peter invited the prospector to move in and make himself comfortable. The prospector paused. "No," he said, "I think I'll go along with the rest of the boys. There might be some truth to that rumor after all." Warren Buffett, 1985. John Maynard Keynes defined speculation as the activity of forecasting the psychology of the market. Keynes went on to say that the speculator must think about what others are thinking about, what others are thinking about the market, and repeat. In what is now called a Keynesian beauty contest, judges are told not to pick the most beautiful woman, but instead to pick the contestant they think the other judges will choose as the most beautiful. The winner of such a contest may be very different than the winner of a traditional beauty contest. Keynes said this about such a contest: "It's not a case of choosing those faces that, to the best of one's judgment, are really the prettiest, nor even those that average opinion genuinely thinks the prettiest. We have reached the 3rd degree, where we devote our intelligences to anticipating what average